Welcome, trader. This is Steven with TMT. No pain, all gain. Now let's trade some knowledge. Dividends, the income of the stock world. Dividends represent a payment from a company to its shareholders. The payment to a shareholder is determined by a rate set by the company and the number of shares owned by the shareholder. This payment is typically delivered on a recurring basis in a frequency set by the company, such as quarterly, semi-annually, or annually. But you may be asking, where does the company get the funds to pay a dividend to countless shareholders? There are a couple of stashes where a company can draw money from in order to pay its shareholders. The ideal stash is the company's earnings. The company will return some of its profits to its shareholders via the dividend. The other stash is the company's reserves. Think of it as a savings account. Drawing money from reserves, however, may reveal the company isn't producing enough earnings to cover its dividend payout. Not all companies pay out dividends. Companies that offer dividends to their shareholders are characteristic of a more mature company with stable and predictable earnings. This is not to say that a company isn't worthwhile to an investor unless it offers a dividend. Some of the best companies, in fact, do not pay out dividends. Instead, they reinvest the cash back into the company in an attempt to grow the company and produce more earnings. However, without dividends, it's expected the company returns value to their shareholders via stock buybacks and stock price appreciation. But let's take a look at how dividends are viewed by the company and by the investor. From the company's perspective, paying out a dividend can be viewed as a bill that must be paid to its shareholders. The dividend both attracts new investors and keeps the current shareholders content. However, new investors and shareholders alike expect the dividend to be paid out in full, on time, and without any complications. This is because it directly affects their expected return. But dividend payouts aren't guaranteed. It's the management's decision how much and how often a dividend is paid. Management is sometimes forced to decrease a dividend payout during times of stress or periods of decreased earnings. This is a major red flag for shareholders since it means a lower than expected return and foreshadows a prolonged period of decreased company earnings. Once this news hits the public, an ensuing sell-off typically follows. On the other hand, management can decide to increase the dividend payout to its shareholders. This typically means the company has experienced an increase in earnings that management believes is expected to continue into the foreseeable future. This increases the expected return in the eyes of investors, and a stock price rally typically follows. Now let's get a better understanding of the dividend process from start to finish. The dividend process is composed of 4 major dates. This includes the declaration date, ex-dividend date, record date, and payout date. The declaration date is the date the company announces to the public it'll be paying out a dividend, the payout amount per share, and the payout date. The declaration typically follows a company's earnings announcement after all the company's financials have been accounted for and reviewed. Once the dividend is declared, an ex-dividend date is set. This represents the cutoff date by which investors must own shares in order to receive the dividend payment. The record date is 1 business day after the ex-dividend date, and is when the company finalizes the logistics of the dividend payout. This means investors can sell their shares on the record date or the days following and still receive the dividend payout. Usually about a month later is the payout date, when shareholders actually receive the dividend payout. When analyzing companies, there are 2 common dividend measures that investors and traders will use. This includes the dividend payout ratio and the annual percent yield. The dividend payout ratio is calculated by adding up the past year's dividend per share payouts and dividing it by the past year's earnings. This reflects the percent of the company's earnings that are returned to its investors. Now, the annual percent yield again utilizes the past year's dividend payouts, but divides it by the current stock price. This reflects the expected annual dividend return if buying at the current stock price. For example, if we assume the dividend is a constant, buying the stock at a lower price will produce a greater dividend yield than buying the same stock at a higher price. Dividends have and always will be a major component in stock analysis and stock selection. How to gauge the quality of a company's dividend largely depends on the company's fundamentals. Price paid and meticulous timing also plays a huge role in generating a high dividend yield. Producing more bang for your buck is the mission for any income-driven investor and something you should strive for on your path to becoming the modern trader.